In 2020, we had this flash crash. Gold and silver fell off a cliff. Gold immediately starts coming back up again, as it should, as a monetary metal should, as a safe haven asset should. And silver just kind of stayed on the mat, right? It's been struggling just to get back to, and it still hasn't hit a new all-time high, nominally even, as gold has. So the market now is, the data is telling us something is different. And you could, I suppose, chalk all of that up to manipulation, but the scale of manipulation to keep silver in the 20s when gold is over 2100 globally, it's just not credible. It's not an easy thing to believe.
Lobo Tiggre, editor of the Independent Speculator, highlights the increased demand for silver, driven by economic recessions and growth, which he believes will positively impact its performance in investment and industrial sectors. The Silver Institute projects a 9% rise in silverware demand and a 6% increase in jewelry demand, with India expected to contribute to the uptick in jewelry purchases significantly. Michael DiRienzo, the executive director of the Silver Institute, shares Tigre's optimism, forecasting silver prices to reach $30 per ounce, a level unseen in a decade, citing expectations for a stellar year in terms of demand. However, Tiggre acknowledges recent market trends where silver has struggled to achieve new nominal all-time highs, contrasting with gold's surge to unprecedented levels, reaching $2,233 per troy ounce as of March 29th. Silver's current value stands at $24.97 per troy ounce, a significant decline from its all-time high of $47.91 on March 31, 2011. Despite silver's challenges, silver is attempting to settle back below the support at $25.30, coinciding with a weakening US dollar against a basket of currencies. Regarding allegations of gold price manipulation by central banks, the potential influence of statements made by influential figures within these institutions on market sentiment and prices. While claims of gold price manipulation exist, concrete evidence must still be included. Arguments suggest that central banks have the motive and means to manipulate gold prices, citing sudden market movements or the timing of gold sales by central banks as examples. However, Tiggre cautions against attributing all market movements solely to manipulation, emphasizing the complexity of market dynamics and the need for credible evidence to support such claims. Come along as we explore the valuable insights provided by Lobo Tiggre. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
The good news is that clearly there's a vastly increased industrial use case for silver. And I do think that is good news because, the investment case, the monetary case doesn't necessarily go away. I'm right about the hard landing and monetary metals get a bid because of the recession. Then that would be gold and silver. That'd be good for silver. If I'm wrong and the economy takes off, well, that's good for industrial demand for silver. So that's good for silver, not so much gold. People call me Darth Silver and all that, but I'm not anti-silver. I'm not even a silver bear. The reason for the name, though, is that something has clearly changed. These numbers that you're pointing to, you can see it on a daily basis. There's over the last year or two, you look at gold and silver and copper on a daily basis, and the silver line intraday will frequently wiggle more with the copper line than with the gold line. So it seems to be responding to the same stimuli, to the same decisions that copper buyers are making than gold buyers frequently. Now, it is still money, of course. It is the word for money in many languages. And especially since the new war in the Middle East broke out, we've seen silver go back to tracking gold more closely. I find this very reassuring. Yes, it is still a monetary metal. So I like that win-win thesis. But the industrial side could certainly hold it back this year. And you said that silver outperforms gold. Well, even diehard silver bulls will tell you it outperforms gold at the end of the bull market. It typically lags at the beginning and then more than catches up at the end. So if we're going in, we've been consolidating sideways since 2020. We're going on 4 years, David. This is no longer the same bull market of 2019, 2020. If we break out again, and we seem to be doing that on the gold side, history tells us that silver will lag at first anyway. If you want to be fanatical about defending your favorite metal or commodity or whatever, fine. Knock yourself out. If there's an ideological agenda here, fine. But don't mistake that for being an investor. If your goal is to make money, what David is saying right now, I mean, this is like truth with a capital T. These are the facts. Just look at it. In 2020, we had this flash crash. Gold and silver fell off a cliff. Gold immediately starts coming back up again, as it should, as a monetary metal should, as a safe haven asset should. And silver just kind of stayed on the mat, right? It's been struggling just to get back to, and it still hasn't hit a new all-time high, nominally even, as gold has. So the market now is, the data is telling us something is different. You could, I suppose, chalk all of that up to manipulation, but the scale of manipulation to keep silver in the 20s when gold is over 2100 globally, it's just not credible. It's not an easy thing to believe.
Would you use a gold silver ratio as
No,
as a trading tool? Like it goes above 80, you're short gold or whatever?
no,
No?
no. First, because it's been continually widening, or not continually, it has with volatility been widening for decades now. Like there was a big breakdown in 2020, but that was just the latest in a trend. The gold silver ratio can close by gold coming down just as easily as silver going up. Anything that gets to an extreme, if the gold silver ratio blows out over 200, say, I would at that point be willing to bet that it would close, or at least somewhat close. But it doesn't tell me which metal is going up and which one's going down.
Lobo Tiggre predicts a hard landing scenario for the economy, exacerbated by post-pandemic distortions such as labor hoarding and market disruptions. He warns that this hard landing could be more severe due to the delay in addressing underlying economic issues. Tiggre's outlook aligns with concerns raised by Ellen Zentner, Morgan Stanley's chief U.S. economist, who attributes the looming hard landing recession to high interest rates, despite markets anticipating the Federal Reserve to loosen monetary policy this year. As indicated by corporate defaults reaching their highest level since the pandemic, according to Moody's Analytics, and a consecutive decline in bank lending over 3 quarters, according to Fed data, signs of stress are beginning to manifest in various sectors of the financial system. However, Tiggre suggests that despite the potential severity of a recession, it could trigger an economic boom due to responses from the Federal Reserve and fiscal policies. Economists have cautioned that high interest rates could precipitate a recession by imposing restrictive financial conditions, with the full impact of rate hikes yet to be felt, as they typically take about 18 months to permeate the economy fully. Let's get back to the interview.
We've seen an earnings recession. Even Wall Street is not entirely divorced from Main Street, so that's interesting to me. We've certainly seen a commodities recession. If Dr. Copper is called that for good reason, okay, we've seen higher copper prices with some interesting optimism coming out of China. But still, the commodities complex has been signaling an economic downturn. We've got conventional indicators from Germany to the UK to other, large economies flashing red around the world. I think it's not much of a stretch to say that there actually is a global recession going on. We're not just looking at indicators, we're looking at a reality right now on the ground. And then the question is the US the exception? Does American exceptionalism apply here? And I would argue that, again, we're in uncharted waters. Given how we got here, if we have the post-COVID distortions in the labor market, the labor hoarding, the companies not wanting to fire people they really don't need, because of how hard it was to find people during and after the COVID situation. So then that pillar that this American exceptionalism rests on, of the strong consumer laborer, right? If that is not as strong as it looks, or if it's artificially been propped up post-pandemic and then that breaks down, then things change in a big way. So if you want a headline, David, my headline is Lobo Tiggre doubles down on hard landing. I really do think that's coming. I think that the degree to which these things that I'm talking about, labor hoarding, post-pandemic distortions in the market, prevented or held off the recession from, the piper from being paid, the degree that you hold him off, that you increase your interest payment when he does show up for payment. So I think the hard landing left to its own devices would be much harder than it would have been had it been left to sort itself out. And then the question, of course, becomes, what do the powers that be do? So I'm doubling down on hard landing, but I do think the money helicopters will fly. And the timing of this is really the critical point. Do the powers that be open the easy money floodgates the moment it looks like that recession is coming, or do they wait until the NBER declares in hindsight, oh yeah, we're in a recession? I have a feeling they may not wait. As we speak on Fed Day, it's really quite striking to hear the debate about whether the Fed should be loosening or how quickly it should be loosening when supposedly the economy is doing so great. The Biden team, not to get political here, but the Biden team keeps pulling their hair out over why Joe doesn't get credit for wonderful Bidenomics, how great that's doing for the economy. But the reality on the ground is not that great. These numbers that they look at don't account for the reality that people are experiencing on the ground. I'm saying things are worse than they look, and these contrived averages and GDP numbers and CPI and hedonically adjusted, super core CPI, all these numbers they keep coming up with. But the reality is different. And I think the reality will be out. And I suspect, though, that Powell and company, that they know this. They can't admit it, but they know it. And so sorry, I'll stop talking, David. My point is, though, that this recession, this hard landing I'm looking for, could trigger the next boom because of the Pavlovian Fed put response and also fiscal policy. Equities could do well, but still industrial commodities are likely to take it on the chin.
In the past 5 days, gold has experienced a notable rise of 2.37%, outperforming silver, which saw a more modest increase of 1.25% over the same period. In light of recent market movements, what factors explain the divergent performance between gold and silver over the past 5 days? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.